Let's dive right into this explainer. Today, we're taking a high-growth, entirely unprofitable tech stock and putting it through the absolute ultimate gauntlet. We're stepping into the shoes of expert investment analysts to run a complete stress test using the time-tested, legendary frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham, completely contrasting them with modern discounted cash flow valuation models. We'll kick things off with a quick snapshot of the company, then rapid fire through the Buffett, Lynch, and Graham lenses, run our quantitative models, and finally bring it all together for a synthesized verdict.
Section 1. Let's get our snapshot of Ouster Inc. so we know exactly what we're dealing with. At the time of running this analysis, Ouster is sitting at $39.80 a share, giving the company a market cap of roughly $2.53 billion. And right away, we hit our core tension. Ouster is a powerhouse in digital LiDAR and physical AI. They are seeing massive, undeniable revenue jumps driven by their REV8 native color LiDAR and Gemini software. Just look at Q1 2026. Revenue hit $48.6 million. That's a 49% year-over-year growth rate, marking their 13th consecutive quarter of growth. But, and this is a massive but, they are fundamentally burning cash, posting a net loss and a negative EPS of 28 cents per share.
Moving to Section 2, let's see how this futuristic hardware company holds up under the Warren Buffett lens.
The Oracle of Omaha keeps it incredibly strict. He demands an understandable business with a durable economic moat, capable and honest management, manageable debt, and crucially, consistent earnings and a high return on equity.
On the plus side, Ouster absolutely has a strong technological edge. That's their moat, integrating hardware and software for smart infrastructure. Management is also executing a very clear path to profitability targeted for 2027, backed by a really solid $211 million in cash reserves. The problem? That lack of consistent earnings and a negative return on equity completely violates Buffett's demand for historical proof. He doesn't care about the promise of 2027, he wants profits today. To put the nail in the coffin, let's look at Buffett's absolute favorite metric, owner earnings. Ouster's Q1 free cash flow is negative $9.84 million. They're burning cash, not generating a surplus for owners. Because there is literally no positive cash flow to value, we can't even establish a margin of safety. For Buffett, this is a firm, undeniable pass at any price right now. Section 3 brings us to the Peter Lynch lens. And spoiler alert, the narrative completely flips here.
Lynch is far more accommodating to companies rapidly expanding their market share. His philosophy is all about investing in what you know, and specifically hunting for what he calls the fast growers. And boy, does Ouster fit that fast grower bucket with its near 49% top-line growth. Now, if we try to calculate his PEG ratio, price to earnings relative to growth, we do hit a wall. With a negative EPS, the native calculation just breaks, unless we make highly speculative forward assumptions. But Lynch also loves a strong balance sheet, and that $211 million in cash with manageable debt looks fantastic to him. You might notice some recent insider selling from the chief revenue officer. Well, it turns out it was just a pre-planned Rule 10b5-1 automated sale, and he still kept 92% of his holdings. Lynch wouldn't bat an eye at that. Under this lens, Ouster is a textbook speculative buy.
Section 4, the Benjamin Graham lens. Brace yourselves because this is where the math gets brutal.
Graham is the father of value investing. He is all about the cold, hard present reality to protect the defensive investor from permanent capital loss. He focuses relentlessly on the margin of safety.
If we run Ouster through Graham's defensive checklist, it actually starts okay. Adequate size? Sure, a $2.5 billion market cap passes. Strong financials? Yep, the cash pile passes. But then, boom. Earnings stability? Fail. EPS is negative. Dividend record? Fail. They don't have one. Moderate price to earnings? Fail. The forward PE is effectively 0. For Graham's defensive investor, Ouster is completely disqualified right out of the gate. It gets even worse if we try to calculate Graham's famous intrinsic value formula, which is the square root of 22.5 times EPS times book value per share. The math actually breaks. Even if we generously assume a book value of around $350 based on their cash and assets to fill in the gaps, multiplying that by a negative 28-cent EPS gives us a negative number. And you literally cannot take the square root of a negative number. Graham's formula mathematically rejects Ouster. A strict value investor wouldn't even look at this until it yields a positive return. All right, Section 5, DCF and alternative valuation models. Let's strip away the historical philosophies entirely and run the raw, modern, quantitative numbers. To build our base case discounted cash flow model, we have to make some clear, transparent assumptions to forecast their way out of this current cash burn. We'll take management at their word and project an aggressive 30% revenue growth rate over 5 years. We'll assume they hit free cash flow profitability by late 2027. Then we apply an 11% tech-weighted average cost of capital, pretty standard for high-growth tech, to discount those future flows back to today, and tack on a 3% terminal growth rate. Check out this sensitivity matrix. Based on that 11% discount rate and 3% terminal growth, our DCF spits out a fair value of $41.20 per share. That means at the current price of $39.80, the stock is fairly valued, but only if they execute that aggressive 30% growth perfectly. Tweak that discount rate even a tiny bit, and the narrative swings wildly. It is an absolute tightrope walk. Let's cross-check that with a couple of alternative models, starting with comparable sales multiples. Ouster's current forward price-to-sales ratio sits at 8.51, but its 5-year historical average is just 6.97. If the market dragged it back down to that historical average, the fair value plummets closer to $32.60 a share. Add in the fact that current and forward EV to EBITDA multiples are deeply negative, and these relative models are definitely flashing warning signs that the stock might actually be overvalued today.
Section 6. Let's synthesize all of this and get to our final recommendation.
This summary board perfectly captures the total friction in evaluating modern tech hardware. You've got the classic value guys, Buffett and Graham, screaming sell or ignore. They see a cash-burning trap and mathematically cannot find a margin of safety. On the flip side, the Lynch model points straight to a speculative buy. Our DCF model lands right on a hold, and Wall Street analysts are aggressively bullish, calling it a moderate buy, with price targets stretching all the way up to $75 based on the massive potential of physical AI.
So, blending all these insights, here is our bifurcated verdict. The upside is undeniable. 49% top-line growth and a massive technological moat in smart infrastructure. The risk is that relentless, ongoing cash burn. At $39.80, Ouster is a definitive hold or pass if you need current profitability and a strict margin of safety. But if you believe their growth engine will successfully outpace that cash burn by 2027, is a solid speculative buy. I'm going to leave you with this provocative thought. As companies like Ouster literally build the automated eyes for our future cities and robotics, are we using outdated microscopes to value them? If physical AI is truly the next frontier, are traditional value formulas fundamentally broken when measuring modern hardware scale? Ponder that for a bit, and thanks so much for joining me for this explainer.